Now let's look at another example. So that's an example of an ATR when it was low. Here's an example of the ATR when it's quite high. And I'm looking, of course, at this kangaroo tail right here. Boom. Okay? Check this out. So this is interesting as well, because now I have a situation where I have the market's been falling, the candlesticks have been rather large, and so therefore my ATR is pretty high as well. It's above my average of 120. In fact, it's right around 150 when the kangaroo tail prints here. Okay? So now I'm thinking, uh-oh, I better be careful. My ATR is telling me that I need to relax a bit here. I don't want to take a large position. Why? Because the market's likely to move rather violently. So I don't want to get caught here with too much risk on the table, whether it be an initial position or pancakes or whatever. So again, my kangaroo tail is in fact triggered, right? I've got a smaller position here, and then I immediately go into a drawdown the first day, and then the second day it takes off and goes up about 100 pips, 95 pips or so. And then the next day it sort of stalls out, and then boom, a couple days later it comes all the way back down to my zone down here, right? And then what happens? But I get another move up. So essentially, I've had a pretty small position here. It's been up as much as 160 pips, and I've been in the hole as much as 160 pips. So it's really chopped around here. Now, it's made sort of a double bottom here, a particularly nice double bottom for those of you that know particular double bottoms that are nice, and it's gone back up to the zone here. Now, what's happening to my ATR here? The market's actually in a pretty strong trend, and the ATR is falling, right? The ATR is going down, suggesting that we have less risk, even though the market is making a pretty strong move. Isn't that interesting? That's interesting. Again, the reason why this is happening, and now here goes the market even more. The market's doing some really big moves here. These candles are pretty big. It's come up to a zone here, and now these ones are coming down here. Pretty big candles. I mean, in 3 days, the market is essentially from the open to the close. In 3 days, it's gone 296 pips, right? But my ATR is slightly below average. Why is it doing this? Well, it's interesting that the market, as represented by the ATR, the ATR sort of lags a little bit, because we have these giant bars here, so the ATR rocketed up, but then we had a bit of chop. Market didn't really go anywhere, but the ATR was really high, telling us to be calm. Then the market starts taking off and really moving, and then our ATR starts plunging. Why does it do this? It does this because the ATR is like any other indicator, it's lagging, right? So what we have represented by our ATR is not really what the market is doing right now, but what it's done previously, 14 bars ago, and that. So that's the only thing I would caution about using really any indicator, but the ATR in particular. Because remember, the ATR is an oscillator, right? Just like a stochastic or any other, like a MACD or something like that, where you're looking at an indicator that's telling you they're essentially, and Ulrich has a very good handle on this in his post, which is the ATR is essentially telling you times of expansion when the ATR is really high, like over here, and times of contraction when the ATR is really low over here. The problem with that, though, is that we generally see this happen a little bit late, right? It's a little bit late. The ATR, when it's really high over here, is saying us be careful. But guess what? The market's already found support here. So the ATR is telling us to be careful over here, but it's already found support. And then over here, the ATR is really falling and really taking off, right? But up here, the ATR was below average when it started falling. It wasn't until it already came down here and found support and stopped really moving that the ATR was really high. Now, you might argue, well, that's really an example of the 14 ATR. Maybe if you're using a smaller ATR, it will be a little bit better. And that is true. So using fewer candlesticks and using more of the recent candlesticks, that's one way to get around that. The problem with that, of course, is it'll get more choppy. This ATR is rather smooth, from slowly down the bottom, moving up to the top, and then slowly moving down again. Well, that smoothness is going to disappear when I move my ATR to a different period, from 14 to say 5 or something like that. In fact, we can do that right now. But before we do that, I just want to talk about what happened here. So the ATR over here, look at how the market's really taking off in a trend. It started really moving up pretty hard, and then the ATR starts to fall, goes to about average, and then falls a bit, and then it rockets up again in another trend, and the ATR is still slightly below average, right around average, and then starts falling. But guess what? The market's still moving up and doing these explosions up and then up again to our zones. And look, it actually printed a kangaroo tail right on the zone that we had drawn back here from the other example, which of course to me is very interesting when the market remembers those levels. But anyway, so the point is here, I would be cautious with the ATR, certainly with the ATR right out of the box at 14 periods. And the reason why is because it might lag a little bit. It might be very good at telling us what when the market's likely to expand and when it's going to contract. But the problem is it's a little bit late. That's what I would say. It's a little bit late. So let's go to the 5 ATR and see what happens here. Now you can see what happens. It actually increases the valleys and the peaks. So again, it's a little bit more choppy. It moves around a little bit more, okay? And so it's not as smooth. It's not as smooth. It's more sensitive, right? Like any indicator, when you start doing things like this, you have these wild swings here. This up here was at around 115 or so, and then down here, it was down here all the way at 72, right? And that was within a few bars it moves that much. So that's all I would say about this, is just be careful if you're using any indicator, because we've got to look out for this, don't we? We have to look out for this lag factor that comes in with indicators. That's all that I would say here. That's all that I would say. Even here, look at what happens here with the 5 ATR. The market's made a big plunge here, right? You'll recall this was back in August. It made this giant plunge here, okay? And the ATR, of course, rockets up because the candles are so large. And then at the peak of the ATR, where it's saying, wow, it's at 300 pips per day here. Be very, very careful. The market just chops around and doesn't really go anywhere. It stays sort of stuck in this area here when the ATR peaks. And then as the ATR starts to plunge and fall and go lower, then the market starts to take off. So I would just say, my point here is just to be a little bit careful of that.